Hi everyone, welcome to chapter 11. In this chapter we are going to discuss about systematic risk and equity risk premium. So let's start. So chapter outline, so it discusses the expected return on portfolio, the volatility of a portfolio, measuring systematic risk, putting it all together. So we'll discuss capital asset pricing model. So learning objectives: calculate the expected return and volatility of a portfolio, understand the relationship between systematic risk and the market portfolio, measure the systematic risk, that is beta, use the capital asset pricing model to compute the cost of equity capital of a stock. So it starts with chapter 10. In chapter 10 we found out that for large portfolios investors expect higher returns for higher risk. So risk and returns are related. So the higher risk you take, the higher returns you expect. The same does not hold true for individual stocks. The stocks that have both systematic and non-systematic risk, only systematic risk is rewarded. Non-systematic risk, stock specific risk, is not rewarded because it is an assumption that you can diversify away that risk if it is non-systematic. Rational investors should choose to diversify. Okay, so I'll open an Excel sheet. We'll discuss about how to calculate risk and returns for a portfolio. Then we'll come back to the presentation and then discuss the rest. Okay, so let me first save this. Okay, so first we are going to discuss about portfolio risk, returns, and then we'll discuss portfolio risk. So what is the portfolio? Portfolio is combination of two or more assets. Portfolio is combination of two or more assets. Now how do you find portfolio return? So portfolio return, PR, or let's say return on portfolio, RP, is equals to weight of asset A. So let's say there are three assets: weight of asset A into return of asset A plus weight of asset B into return of asset B plus weight of asset C into return of asset C. If there are more than three assets, you continue weight of asset D into return of asset D, and so on and so forth, where weight of asset A equals to market value of A divided by total investments. Weight of asset B equals to market value of B divided by total investments. And weight of C equals to market value of C divided by total investments. Okay, and RA, RB and RC are returns. So R is returns. So returns on a portfolio is nothing but weighted average on that portfolio. Now let's take an example and understand it. So let's do two examples. First, a two asset portfolio. And then we'll do a three asset portfolio. Okay, so let's say you are given that you are creating a portfolio by two stocks, stock A and stock B. You have put $50,000 into stock A, 50,000, let's say $60,000 in stock B. So your total investment is 50 plus 60, 110,000. Stock A is expected to, I'll just insert few columns. Stock A is expected to give you 11%. Stock B is expected to give you 9%. So what is the return, the total return that you receive on this investments? So how to do it? So for finding out portfolio returns, you need weights and returns. You know the returns actually. Stock A gives 11%, stock B gives 9%. We do not know the weights. So first we have to calculate weight in A and weight in B. Now how to calculate weight in A? It is how much is the value in A divided by total investment, and here it is value of B divided by total investment. So it is 45% and 54%. Then we can calculate return on portfolio. And it is calculated as weight of asset A into return of asset A plus weight of asset B multiplied by return on asset B. So weight into returns, weight into returns. So return on this portfolio is 9.91%. The return on this portfolio is 9.91%. Sometimes they give you 3 asset portfolios. So they give you stock A, stock B, and stock C. Okay. So let's say you are putting in 10 grand in stock A, 40 grand in stock B, and 25 grand in stock C. So in total you're putting 10 plus 40 plus 25, $75,000. Stock A gives you 9% return, stock B gives you 15% return, and stock C gives you 6% return. So what is your return on portfolio? What is your return on portfolio? Now to find out returns, first we need to calculate weights, W. So weight of asset A is 10 grand investments in stock A divided by total investments. Okay. B is investment in stock B divided by total investment. C is investment in stock C divided by total investments. So if you look at in percentage, 13%, 53% and 33%. Now what will be returns on portfolio? Returns on portfolio will be weight of asset A multiplied by return on asset A plus weight of asset B into return of asset B plus weight of asset C into return on asset C. So portfolio return is 11.2%. Portfolio return is 11.2%. So this is concept of returns on portfolio. Now what happens to portfolio risk? We are going to discuss this in the PowerPoints too, presentations too, but right now I'm giving you a brief, right, and steps to calculate it so that you have it in Excel, and then we'll go back to the PowerPoint and we'll discuss it more. So risk, portfolio risk depends on 3 things: weights, So individual weights, then individual standard deviations, and correlations between assets. Correlations between assets. So what is individual weights? So what does it mean? So let's say you're putting more money towards risky assets, right? I have two stocks. One is Tesla, another one is, let's say, Bell. Okay, Bell Limited. So Tesla is much more risky. If I put more money in Tesla, my portfolio will have more risk. If I put more money in Bell, my portfolio will have lower risk. Individual standard deviation, if Tesla becomes more riskier than what it was before by taking on some additional like space projects, then the risk goes up also. And correlation. What is correlation? Correlation is movements between two assets. So imagine there are two options. Option 1, to create a portfolio by including WestJet and Air Canada, and option 2, to create a portfolio using WestJet and Suncor. Now which portfolio will have lower risk? Which portfolio will have lower risk? Now if you see option 1, you're creating a portfolio by two similar companies, like WestJet is an airlines, Air Canada is also an airlines. So airlines depends on like mostly oil prices. So for airlines, lower oil prices are good. So if oil prices goes up, then you will face losses, right? You will your profit margins will shrink. If oil prices goes down, your profit margins will expand. So lower oil prices are good, but your portfolio is completely, means both of the stocks, WestJet and airlines, will react in the same way. If oil prices goes down, both react well, so you get better returns. But if oil prices goes up, then both go down in market price, so you will suffer losses. But if you create a portfolio using option 2, now again oil price is an important variable for these two stocks, but WestJet benefits from lower oil price beneficial for WestJet, and higher oil price beneficial for Suncor. So what we can see, if oil price goes low, WestJet would benefit, so your portfolio should be fine. If oil price goes high, then Suncor will benefit and your portfolio should be fine. So risk of option 2 will be much less than option 1 because the correlations are low. What is correlation? Movements between those two assets. So if the assets move in the same direction on change of some variable, let's say oil price, if they react in a similar way to oil prices, the correlations are high. If they don't react in the same way to oil prices, correlations are low. So when you create a portfolio, risk also depends on correlations. When you create a portfolio, risk also depends on correlations. Okay, correlations are high, risk will be higher. Correlations are low, risk will be lower. Okay, so coming back, portfolio risk depends on individual weights of assets, it depends on individual standard deviation, and it depends on correlation, movement between two assets. Now let us see how to calculate it. Now I'm going to write down the steps for portfolio risk. for two assets. Two asset portfolio. Okay. So portfolio risk will depend on weights. So you have to find out weight of asset A and weight of asset B, because you have two assets. So weight of asset A, weight of asset B. It depends on standard deviation. So you have to find out standard deviation A and standard deviation B. We discussed in last class how to calculate standard deviations if not given. Generally they will give you. And third, it also depends on correlation. So correlation between A and B. Okay. Now how to find out risk? So finding out risk is a two-step process. First you calculate variance. The variance is calculated as weight of asset A square into standard deviation A square plus weight of asset B square into standard deviation B square. So weight of asset A the whole square into standard deviation A whole square plus weight of asset B whole square plus standard deviation B whole square into 2 times weight of asset A, weight of asset B, standard deviation A, standard deviation B into correlation AB into correlation AB. So this is step 1, calculate variance. Step 2, calculate standard deviation. So portfolio standard deviation equals to square root of variance, equals to square root of variance. We take a square root of step 1. Okay, we get portfolio standard deviation. So whenever they are asking you to calculate portfolio risk, find out weights if they are not given, weight of asset A, weight of asset B, find out standard deviations if not given, and find out correlation. Okay, and then use this formula to calculate variance. Weight of asset A square plus standard deviation into standard deviation A square plus weight of asset B square into standard deviation B square into 2 into weight of asset A, weight of asset B, standard deviation A, standard deviation B into correlation AB. That is variance. Then calculate portfolio standard deviation by using square root of variance. So let's do it. So let's say you are creating a 2-stock portfolio, stock A and stock B. So stock A you're putting 20,000, stock B you're putting 40,000. So your total investments is 60,000. Stock A has standard deviation of, let's say, 3%. Stock B has standard deviation of 5%. And correlation between A and B, stock A and B, is 70%. Correlation between stock A and B is 70%. Now how do you find out portfolio risk? How do you find out portfolio risk? So first, step 1, we need weight of A and weight of B. Then we need standard deviation A, standard deviation B. Also we need correlations between A and B. So let's see what is given, what is not given, and then proceed. So first find out if all these things are given. Weights are given, standard deviations are given, and correlations are given. Now weights are not given, but we can find it out. 20 grand in stock A divided by total investment 60. 20 grand in stock A divided by total investment 60. So weight is 33%. It is 40 grand in stock B divided by total investment 60. So 66%, 67%. Standard deviation A is directly given. So you need to calculate 3% and 5%. Correlation is directly given. So it is 70%. Okay. Correlation is directly given, that is 70%. We have to find out the risk. So it's a two-step process. Find out variance first and then find out standard deviation. So how to calculate variance? So the formula is weight of asset A to the power 2 multiplied by standard deviation A to the power 2, okay, plus weight of asset B to the power 2, so raised to the power 2, into weight of asset B to the power 2 into standard deviation to the power 2 into 2 times weight of asset A into weight of asset B into standard deviation A into standard deviation B into correlation A and B. So multiply everything. 2 times weight of asset A, weight of asset B, standard deviation A, standard deviation B into correlations between A and B. So variance is some number. We are more interested in standard deviation because risk is given by standard deviation. So you take a square root of that. So your standard deviation risk is 1%. So if you combine weight of asset A and weight of asset B, your risk goes to 1%. Now, what would be the relationship between correlations and standard deviation? So let's say correlation was 70%. So if correlation was 25%, okay, or let's say 10%. So it's changing, but it's not changing much. But what you can see is, so if 70% was the case, the correlation was higher, the variance was higher. So risk is higher if assets are closely correlated. So let's say I'll make some changes so that we get a good figure here. I'm changing the risk. So stock 1 has 11% risk. Stock B has, let's say, 9% risk. So both are more riskier, so that we can see the impact. Correlation 70%, risk becomes 3.68. If correlation was 10%, risk goes down. So as the correlation decreases, the risk goes down, the risk lowers. Okay. So this is how you calculate portfolio returns. Okay. 2 asset, 3 asset. This is how you calculate portfolio risk. We are currently discussing 2 asset. Mostly in exam they ask you 2 assets, but 3 asset is the same step. I'll discuss 3 assets when we discuss the PowerPoints too. But how to do it? Find out weight, standard deviation, correlation if not given. Find out variance first, then calculate standard deviation. Okay. So let's go back to the PowerPoints and then discuss them. So we were here. So expected return on portfolio. First we have to find out portfolio weights. So portfolio weights, the fraction of total investment in a portfolio held in each individual investment. So value of investment in I divided by total value of portfolio. So portfolio weight always adds up to 100%. So weight of 1 plus 2 to n equals to 100%. So portfolio weights for a portfolio of 200 shares of WestJet at $200 each and $100 of Barrick at $60 each. So how to do it? So find out total investment. Total investment is $200 into 60 in $200 into 200 plus $100 into 60. Then find out weight of WestJet. So let's do that. So how to find out weights? Weight of asset A and weight of asset B. So for that we need total investments. So how much total are you putting? $200 into 200 plus 100 shares at 60. So this should be 100, not 1000. There is an error here. So let's do it the right way. 100 into 60. So total investment is 46 grand. How much are you putting in stock A and how much are you putting in stock B? Stock A you're putting $200 and 200 shares, so 40. How much are you putting in stock B? You're putting $60 into 100 shares, right? 100 shares at 60. So can you calculate weight of asset A and weight of asset B? Yes, we can do that. So it will be 40 grand investment in A divided by total investment and 6 grand investment in B divided by total investment. So it is 87% and 13%. So this is wrong. So make the changes. Return on portfolio. The return on the weighted average of returns on an investment where weights correspond to portfolio weights is return on portfolio. So return on portfolio P is equal to weight in asset 1 into return in asset 1 plus weight in asset 2, return in asset 2, so on and so forth. Okay. So they're giving you an example. Suppose you invest $100,000 and buy 2,000 shares of WestJet at $20 per share, 40,000, and 1,000 shares of Barrick at $60 per share, 60,000. If WestJet stock goes up to 24 from 20 and Barrick stock goes up to 50, falls to 57 and neither pays any dividend, what is new value of portfolio and what is return on portfolio? So let's do that. Okay. So stock A, you're putting 40,000. Okay. What is return on stock A? So it went to 24 from 20 minus 1. So how did I do it? 24 final value, right, or future value divided by present value 20 minus 1. So 20% return in stock B. What is stock A? Sorry, stock B is total investment is 60,000. What is the returns? Returns are RB. Returns are, it went to 57. So 57 divided by 60 minus 1. 57 future value, 60 present value or investment minus 1. So 5%, negative 5%. Okay. So what is weight of asset A and what is weight of asset B? Because to calculate returns we need weights. So weight of asset A, total, we need total investments to calculate weight. So let's do first total investment. So total investment is 40,000 plus 60,000. 100,000 is the total investment. So what is weight of asset A? 40 divided by 100, 40%. What is weight of asset B? 60 divided by 100, 60%. Okay, so let's calculate portfolio return. So returns on portfolio equals to weight of asset A into return of asset A plus weight of asset B into the return of asset B. So total portfolio returns are 5%. So how much will be your final portfolio value? Final value of portfolio. So you had 100 grand into the portfolio. It grew by 1 plus 5%. So your portfolio value will be 105 grand. Okay. So this is how you do it. Show that equation 1 is true by calculating individual returns and multiplying them by weight. If you don't buy or sell any stock after the price change, the new portfolio weights are, so this goes up and this goes down. So to compute the return on portfolio, compute its value using the new prices and compare it to the original investment. So they have done the same thing. 5% is your total return, or 5 grand is your total, means $5,000 you earn, that is 5% of your investment. I have done it in a little bit easier way. So Barrick WestJet stock goes up 20%, Barrick stock goes down 5%. Then return on portfolio, we need weights and returns. So weights into returns, weights into returns, so total return. The new weights becomes 45% because stock A has gone up more, and 54% because stock B has gone down. Okay, so you can pause and read it. It's the same discussion. Okay, so expected return on a portfolio, it's nothing but weights into expected return on assets. So weight into expected return on 1 plus weight into expected return on 2, so on and so forth. So they've given one more example. Suppose you invest $10,000 in Loblaws Limited, right, and $30,000 in TransCanada Limited Corporation, TRP. You expect return of 10% for Loblaws and 16% for TransCanada. What is the expected return on portfolio? So let's do that. So stock A, you're investing $10,000, which is Loblaws. Okay. Stock B, you're investing $30,000. We know the returns. Returns on stock A are 10% and returns on stock B are 16%. Okay. Steps to do it: always find out total first. So total 10 plus 30, 40 grand. Find out weights: weight of asset A, weight of asset B. Weights: 10 divided by 40, 30 divided by 30 divided by 40. Investment in B divided by total investment. So we now know weights, we know returns, we know weights, we know returns. So we can calculate portfolio returns, which is nothing but returns into weights plus returns into weight. So 14.5 is the total return on this investment. So 25% is the weight in A, 75% is the weight in B. Corresponding returns are given. So weight into returns, 14.5% is the answer. The importance of each stock for expected returns on our portfolio is determined by relative amount of money you have invested in it. Most 75% of your money is invested in TransCanada. So overall expected returns of the portfolio is much closer to TransCanada than it is to Loblaws. Investors care about returns, but they also care about risk. When we combine stocks in a portfolio, some risk is eliminated through diversification. So whenever you combine stocks, right, stock specific risk or unsystematic risk is completely eliminated. So you're left with only systematic risk. Remaining risk depends upon the degree to which the stocks share common risk. The volatility of a portfolio is the total risk measured as standard deviation of a portfolio. Table 11.2 shows returns of 3 hypothetical stocks along with their average returns and volatilities. Note that while these stocks have the same volatility and average returns, the pattern of return differs. When the airline stocks performed well, the oil stocks did poorly, and when airlines did poorly, the oil stocks did well. So it is discussing investments in some oil company and some, let's say, airlines company. So whenever airlines do well, oil companies generally don't do well, and vice versa. And equal investments in 2 airlines, NorthJet and SouthJet. So we are creating 2 portfolios, equal investment in 2 airlines or equal investment in 1 airlines and 1 oil company. The average return of both portfolios is equal to the average return of stocks. The volatility of these portfolios are very different from volatility of individual stocks. This example demonstrates, like, if you combine portfolios that have lower correlation, they do not move together, they are different, right, then the risk goes down further. So risk is directly impacted by correlations. By combining stocks into a portfolio, we reduce risk through diversification. The amount of risk that is eliminated depends on the degree to which the stocks move together. Combining airline stocks reduces volatility only slightly compared to individual stocks. Combining airlines and oil stock reduces, more risk is cancelled out, making the portfolio much less risky. Measuring stocks co-movements or correlation. To find the risk of portfolio, we need to know the risk of component stocks and degree to which the returns move together. Correlation ranges between -1 to +1, the measure of degree to which returns share common risk. How to calculate correlation? Correlation is calculated as covariance between 2 assets, R1 and Rj, divided by individual standard deviation. So standard deviation of Ri and standard deviation of Rj. So sometimes they give you correlation. So first find out so sometimes they give you covariance and standard deviation of individual assets. First you have to find out correlation and then find out risk. So how to do it? So correlation between A and B is calculated as covariance between A and B divided by standard deviation A into standard deviation B. Okay, standard deviation A into standard deviation B. So let's say covariance is given to be 30. Okay, standard deviation A SA is 5% and SB is, let's say, 9%. So what is correlation? It is 30 covariance divided by standard deviation A times standard deviation B. Okay, so it should be percentage. So correlation is 66%. So stock returns tend to move together if they are affected similarly by economic events. So stock in the same industry tend to have more high correlations with each other than stocks in different industries. So what is the bottom line? Bottom line is it is better to combine stocks that are in different industries. Table 11.3 shows volatility of individual stock returns, correlations between them for several common stocks. Okay. So this is given in the book, you can have a read. Now, what is the volatility or risk of a portfolio? So risk of a portfolio is given by first calculate variance. So variance of portfolio equals to weight of asset A square, standard deviation of asset A square, plus weight of asset B square, standard deviation B square, plus 2 into weight of asset 1, weight of asset 2, correlations between A and B, into standard deviation of A, standard deviation of B. So the three part of equation 1 each account for important determinant of overall risk of a portfolio. So risk of a portfolio depends on risk of stock 1, risk of stock 2, and how they are correlated. So third variable is correlations. The expected return on stock is equal to weighted average expected return on stock. The risk of portfolio is lower than weighted average of individual stocks unless all stocks have perfectly positive correlation. So if stocks have correlations of 1, then you just have to take weighted average. Otherwise you have to use that formula. So diversification is important, and the best way to diversify, include stocks in your portfolio coming from different industries. Using the data from 11.3, what is the volatility of a portfolio with equal amounts invested in Stanlac and Canada Pacific? What is the standard deviation of a portfolio with equal amounts invested in Loblaws and things? So these things are given. So weights are given, volatility is given, correlations are given. So you have to find out if you create a portfolio of Stanlac and Canada Pacific, how much will be the standard portfolio risk and how much will be portfolio risk of Loblaws and things. So what I'm going to do is I'm going to copy this table in Excel and then we can solve it. So first let us solve for, this is portfolio A, okay, and this is portfolio B. We have to find out risk of portfolio A and risk of portfolio B. So how to do that? So it's a two-step process. First find out variance and then find out standard deviation of portfolio. So let's calculate variance first. So how to calculate variance? So variance is always weight of asset A squared plus standard deviation of asset A, volatility is standard deviation, squared, okay, sorry, weight of asset A square into standard deviation of asset A square plus weight of asset B squared into standard deviation of B squared, and third variable plus 2 times everything, weight of asset A, weight of asset B, standard deviation B, standard deviation A into correlations between A and B. So variance is whatever, right? We are more interested in standard deviation. So square root of variance is standard deviation. So standard deviation of portfolio is 19.8. 19.32%. Standard deviation of portfolio is 19.32%. So let's do same thing for portfolio B. How to do it? So weight of Loblaws squared into standard deviation of Loblaws squared plus weight of CN squared into standard deviation of CN squared times 2 into everything. So weight of Loblaws, standard deviation of Loblaws, CN weight, standard deviation CN, and correlations between Loblaws and CN. And finally we take a square root of that to find out portfolio risk. So portfolio risk is only 8.5% in B. Portfolio risk is 19% in A. Why? Because Canada Pacific and Stantec is in similar lines of business, so their correlations are higher. Loblaws and CN are in very different industries, so their correlations are lower. So lower the correlations between your portfolio, between your stocks, the higher is the risk reduction. So risk has gone down significantly, 17, 24 and 8. So there is a big drop, right? Here 24, 22 and 19. So it is a drop but not that significant. So it is much better to combine assets with lower correlations. So they have done the calculation. So 19.3 is the answer for 1. 15.2 is the answer for 2. That's not right. Not 0.4. So there is a mistake here too. The correlation is 0.7. They have taken, okay, they have taken 0.07 and they have taken here 0.7, that is 70%. So that will change dramatically, but in the table they have given 0.07. So we have taken the right one. So there is a mistake here. It should be 0.07. So it's not 15.2. It is what we found out, 8.51. The weight, standard deviation and correlations are needed to compute the variance and then standard deviation. Here we computed the standard deviation of a portfolio of Stantec and Canada Pacific to 19% and let's say Loblaws to be 8%. Note that both portfolios are less volatile than either of individual stock. The portfolio of Loblaws and CN is also less volatile than portfolio of Stantec and Canada Pacific. The much lower correlation between Loblaws and Canada Natural Resources leads to greater diversification benefit in portfolio. So bottom line, lower the correlation, lower will be the total portfolio risk. We can return to one of the main goals of the chapter, how an investor can create an efficient portfolio. We will also discuss a simple case, an investor who can choose between two stocks. So consider a portfolio of Intel and Coke. So Intel, expected returns is given, volatility is given, correlations are given. Coke, expected return, volatility and correlations. Now point to note, Intel and Coke are in very different businesses, so their correlations are 0. They are taking correlation as 0. So how should the investor choose a portfolio of these stocks? So let us compute the expected returns and volatility for different combinations. So consider a portfolio with 40% in Intel, 60% in Coke. We can compute returns, we can compute risk. Okay, so what are they doing? They're changing weights. So 0% in let's say Coke and 100% in Intel, 20% in Coke, 80% in Intel, 60% in Intel, 40 and finally 100% in Coke, 0% in Intel. Okay, so they are creating two portfolios and changing the weights. Expected returns you can calculate, the risk you can calculate. Okay, then you can suppose the investor considers investing 100% in Coke stock. We can see from figure 11.4. Other portfolios such as 20% in Intel stocks and 80% in Coke stock make investors better off. They have higher expected returns and they have lower volatility. Investing solely in Coke is not a good idea, because if you see, investing solely in Coke has returns of 6% and risk of 25%. But if you go 20-80, returns increases and risk goes down. So it is better to have Intel in your portfolio than investing 100% in Coke. Investing in solely Coke stock is inefficient, and the same is true for all portfolios with more than 80% in Coke stock. Inefficient portfolio, when it is possible to find another portfolio that is better in terms of both expected returns and volatility, then the portfolio is called as inefficient portfolio. An inefficient portfolio is inferior to another portfolio with higher returns and lower volatility. We can rule out inefficient portfolios and inferior investment choices as they are clearly dominated by one or more of the efficient portfolios. We cannot easily rank efficient one. Investors will choose among them based on their own preference of returns versus risk. Efficient portfolio, a portfolio is efficient if it offers highest possible returns for a given level of volatility. Efficient frontier, it is set of all efficient portfolios, which is known as efficient frontier. Okay, so what is the bottom line? When you look at different combinations of stock A and stock B, so Coke and Intel, there would be some portfolios that are not efficient. Means for the same amount of risk and return, right, you have a better combination. So Intel had returns of 6%, risk of 25%. So better than that, if you go 20% in Intel and 80% in Coke, then you have higher returns of 10% and even lower risk. So the portfolios are inefficient. Some portfolios are inefficient and you have to completely ignore them. So Emily Ashley has invested 100% of her money in Coke stock and is seeking an investment advice. Which portfolio would you recommend? You should recommend that Emily put 40% of her money in Intel stock and 60% in Coke. The portfolio has same volatility of 25%, but the expected return is 14% rather than 6%. Effect of correlation. Correlation has no effect on expected returns on a portfolio. However, the volatility of a portfolio will differ depending on the correlation. The lower the correlation, the lower is the volatility we can obtain. As we lower the correlation and therefore the volatility of portfolios, the curve showing portfolio will bend leftward to greater degrees. So bottom line, it is better to combine stocks that have lower correlation than to combine stocks that are highly correlated. So it is better to have a portfolio in which you have some pharma stocks, some manufacturing stocks and some tech stocks rather than just investing in tech stocks. Your risk will be higher. Volatility declines as the number of stock in the equally weighted portfolio grows. Most dramatic initially, going from one stock to two stocks, reduce the risk much more going from 100 stocks to 101 stock. So as the number of stock increases, the volatility goes down, but the rate of change of volatility going down reduces. For every large portfolio, systematic risk always remains. So you are just diversifying non-systematic risk. Our goal is to understand the impact of risk on individual firm investors so we can quantify the relationship between risk and required return, produce a discount rate for present value calculations. To recap, the amount of stocks risk that is diversified away depends on its correlation with other stocks in the portfolio. With large enough portfolio, you can diversify all unsystematic risk, so you will only be left with systematic risk. Systematic risk you cannot diversify. So there is a concept of market portfolio. Market portfolio means if you invest in a particular index, the sum of all investors' portfolio must be equal to portfolio of all risky securities in the market. The market portfolio is a portfolio of all risky investments held in proportion to their value. Thus, the market portfolio contains one of the largest companies and less of the smaller companies. So aggregate portfolio. So aggregate market portfolio is 1,000 shares of each. So let's say you just have two stocks listed in the market. So whatever is the market cap of A, you will put your money in that. Whatever is the market cap of B, you will put money into that. Everyone wants to hold the market portfolio, and sum of everyone's portfolio must be equal to market portfolio. The investment in each security is proportionate to its market cap. So whenever you create a market portfolio, right, the investment that you put in into a particular stock depends on the market cap. Market cap is nothing but number of shares outstanding into price per share. Since stocks are held in proportion to their market cap, we say that portfolio is value weighted portfolio. So generally stock indexes are used as market portfolio. We use a market proxy, a portfolio whose return should track the underlying unobservable market portfolio. The most common proxy portfolios are market indexes. The market index reports the value of particular portfolio. So market index can be S&P TSX Composite Index, which covers around 250 stocks, and it covers 85% of all listed companies in Canada. S&P TSX 60, which composes of 60 companies. Dow Jones, which consists of mostly industrial companies and number of companies is 30, and S&P 500, which has 500 large companies in US. So if you are a Canadian investor, it is better to have TSX Composite as your market portfolio. If you are an American investor, it is better to have S&P 500. We compare a stock's historical return to market historical return to determine stock's beta. The sensitivity of investments to fluctuation in market. So what are they discussing? We have discussed that total risk is given by standard deviation, but sub part of total risk. So total risk of a stock, I'll zoom up. Total risk of a stock is given by standard deviation. Now we have discussed total risk is composed of systematic risk, that is market risk, and unsystematic risk, that is stock specific risk. Now if the portfolio is large enough, this unsystematic risk is zero because you have diversified that away. So only risk remaining is systematic risk. Now systematic risk is given by a Greek function called as beta, right? So it's pronounced as V because it's a Greek name. Okay. So systematic risk is given by beta, right? Now what is that? That is correlation between stock and index. So if a stock is more risky, it will have high beta. If a stock is less risky, it will have low beta. Okay. Now beta is important. Beta is important because it is used in CAPM model. So what is CAPM model? CAPM model is expected return from a stock is given as risk-free rate RF plus return on market minus risk-free rate times beta. Okay, where RF is risk-free rate, okay, RM minus RF is excess return, okay, RM is market return minus risk free, that is called as excess return, and beta is risk of stock, systematic risk of stock. Okay, so returns from any stocks are a function of risk-free rate in the market plus return on market minus risk-free in times beta. So the sensitivity of an investment to fluctuations in the market portfolio is given by stocks beta. Use excess return, security less risk-free rate, percentage change in stock returns that we expect, each 1% return. So beta of overall market is 1. The difference in beta by industries are related to sensitivity of each industry's profit to general health of economy. Suppose in the coming year our expected annual return of Loblaws is 6% and for natural resources, Canadian natural resources, it is 12%. What is the expected return and risk, standard deviation of portfolio if you hold only Loblaws? If you split your money evenly between Loblaws, what is the expected return and risk? So we can calculate that. Standard deviation is 15%, 17%. With this information we can compute the expected returns. Expected returns comes to 6% and 17% if 100% of your money is in Loblaws. Expected returns comes to 9% if you equally divide your money between Loblaws and Canadian natural resources, and standard deviation is 15%. Despite this significant increase in expected return, we gain reduction in risk. This is the advantage of portfolios. By selecting stocks with low correlation, we can achieve our risk of a high expected return. Estimating beta from historical return. Beta is expected percentage change in excess of returns of a security for 1% change in market. So what is beta? So let's say there are 3 stocks, stock A, stock B, stock C. Stock A has a beta of 1.1, stock B has a beta of 0.7 and C has a beta of 0.25. So what does it indicate? So if the market is changing, market goes up by 10%, okay, it goes up. So stock 1 will go up by 11%. So 1.1 times 11. Stock B will go up by 7% and stock C will go up by 2.5%. Stock C will go up by 2.5%. But if market goes down by 7%, if market goes down by 7% or 10%, down, so negative 10%. So stock A will go down by 11%, stock B will go down by 7% and stock C will go down by 2.5%. Okay, so this is how you can imagine beta. So stock is having more than 1 means it reacts more than the market. If it is less than 1, it reacts less than the market. Lower the beta, lower is the reaction to market. Okay, how do you estimate beta from historical returns? So you plot returns of particular stock, you plot returns of particular mark of index, and then you compute. So I'll show you how to do it. So let's say we know stock A's returns in the last 10 years. Okay, and we know index returns in stock in last 10 years. So I'm just putting some random numbers: 12%, 11%, minus 20%, 35%, 3%, 2%, -1%, 9%, 15%, and let's say 6%. And index returns are also known. So you will plot stock returns and then you will also plot index returns. So index returns, let's say 11%, 10%, -6%, 15%, 5%, 4%, then 1%, let's say. Here it is 7%, 11%, 3%. So these are returns of stock A, these are returns of stock B. You have to calculate beta. So you can't do this like. So we have plotted stock A and stock B. You can't directly use beta function. So what you have to do is select these two returns, go to the data tab, then go to data analysis. Okay, we need correlation analysis. No, we need regression analysis. Beta is found by using regressions. So do equals to, so you need x is stock, okay, you need y is index, okay, do equal, okay. So you will get the output. This x variable is beta. So whatever output you get multiple R square, adjusted R, standard error, observation, regressions, intercept, all this stuff. You're not interested in that. You're interested in this function. x11, x variable 1, that is nothing but beta. So beta of this stock is 2.16. Okay. That's how you find out beta. So going back, so overall tendency, so they are doing it with CN. CN is more riskier than the market, so it reacts more, it's greater than 1. Beta corresponds to slope of best fitting line. Beta measures the expected change in Canadian resources per 1% change in market returns. The deviation from line best fits, right? One of our goals in this chapter is to compute the cost of equity capital, the best available expected return offered in the market on a similar investment. To compute cost of equity, we need to know the relationship between stock risk and its expected return, which is given by CAPM model. So CAPM model we have discussed. Just before this, CAPM model is given by returns on expected returns on any stock is risk-free rate plus return on market minus risk-free times beta. So expected return on any investment comes from risk-free rate, risk premium, and sensitivity beta. So given as risk-free rate plus beta of the stock into expected return on the market minus risk-free. The CAPM model says that expected returns on any investment is equal to risk-free returns plus a risk premium proportional to amount of systematic risk in the investment. The risk premium is equal to market risk premium times the amount of systematic risk present in the investment. We can call this returns the investment's required return. Suppose the risk-free rate is 3% and market risk premium is 6%. Beta of Canadian Natural Resources is 2.25. What is the CAPM return? So they have given you. Let's solve it. So expected return from the stock or cost of equity for the stock is risk-free rate plus return on market minus risk-free times beta. So risk-free rate is given to be 3% plus return on market risk premium to be 6%. So this is given return of market minus risk-free, that is straight away given to be 6% times 2.25. So 16.5 is the expected return on Canadian Natural Resources. So 3% plus 2.25 into 6%. So sometimes they give you this market risk premium directly. Sometimes they give you expected market returns and they give you risk free. Then you have to calculate it. Because Canadian Natural Resources beta of 2.25, investor will require a risk premium of 13.5% over the risk free rate. Right, so 16.5% is the answer. So based on the expected returns and beta, you can compute a security market line. So CAPM implies a linear relationship between stock beta and the expected return. So this you can graph it out. So okay, higher the beta, higher would be the expected return, higher would be the risk. Okay, suppose the stock of George Weston Limited has a negative beta of 0.15. How does its required return compare to risk-free rate according to CAPM? Okay, so whenever beta is negative, the expected return will be lower than risk-free. Your expected returns will be lower than risk-free. Okay, does that mean that the stocks are not good investments? No, it doesn't mean that. It means that if you include those stocks in your portfolio, your risk will go down significantly. We can use CAPM to compute the expected return of this negative beta stock like we would do for positive. We don't have the risk-free rate or market risk premium, but the problem does not ask us for exact expected return, just whether it will not be more or less, right? Because the expected return is higher than risk-free rate implies that expected return on WN will be below risk-free. So whenever the stock has negative beta, the returns will be below risk-free. As long as the market risk premium is positive, right, the returns will be higher. So if you compute it, 3%, the sign becomes negative because beta is negative, 0.15 into market risk of 6%, so 2.1, which is lower than risk free. The result seems odd. Why would investors be willing to accept 2.1 expected returns for a stock when they can invest in safe investments earning 3%? The answer is that savvy investors will not hold WN alone. Instead, they will combine it in their portfolio. And since it has negative beta, then the diversification benefits is large. So if you include even small portion of this stock, your overall risk of the portfolio goes down. Okay, because WN has negative beta, its correlation with the market is negative, which means that WN tends to perform well when the rest of the market is doing poorly. Therefore, by holding WN, an investor can reduce the overall market risk of a portfolio. In a sense, WN is a recession insurance for a portfolio, and investors will pay for this insurance by accepting lower expected returns. The CAPM model and portfolios, we can apply the SML to portfolios as well as individual securities. The market portfolio is on SML, and according to CAPM and other portfolios are also on SML. So if you put it all together, the expected return on a portfolio should correspond to portfolio's beta. So beta of a portfolio is weight of stock 1 into beta of stock 1. So it's just the weighted average. So beta of a portfolio is weighted average of different stocks. So they have given an example. Suppose the Canadian Railway has a beta of 1.2, Loblaws has 0.5, risk-free rate is 3%, and market risk premium is 6. What is the expected return of an equally weighted portfolio between Canada Pacific and Loblaws? So we have following information. Risk-free rate is given, betas are given, weights are given. We can compute the expected return of portfolio in two ways. First, we can use the CAPM model to compute the expected return, and then compute the expected return using equation 3. So if you use CAPM model, so expected return on CP, risk-free rate plus beta into risk premium, risk-free rate plus beta into risk premium, then compute the expected return. So 0.5 into 10.9, 0.5 into 6.8. Second, we can just use weighted average, like weighted average of, we can find out portfolio beta first. So weight of portfolio A, weight in asset A into beta of asset A plus weight in Loblaws into beta of Loblaws. We calculate that beta. Then we can find the portfolio's expected return from CAPM, risk-free rate plus beta into market risk premium. So 3% plus 0.5 into 6%. So both answers are same. Two ways to do it. As mentioned in previous slides, you can compute the expected return of each securities using its beta, and then compute the weighted average returns of those expected returns. The weighted average returns to get the portfolio beta, and then compute the expected returns using CAPM. So summary of capital asset pricing model. Investors require a risk premium proportional to amount of systematic risk that they are bearing. We can measure systematic risk using beta. The most common way to estimate beta is to regress its historical returns on market's historical return. The stock beta is slope of a line that best estimates the relationship between market's return and stock return. So CAPM model says we can compute the expected return using the following equation. Expected return equals to risk-free rate plus beta into market risk premium. And that's it.